$100 invested in 1988 grew to $398.7 million by 2018, per a Cornell Capital Group analysis. Not in Bitcoin, not in a tech startup, in a single hedge fund that most people have never heard of. That fund, the Medallion Fund, run by Renaissance Technologies, averaged 66.1% gross annual returns for 30 straight years, per data compiled by Gregory Zuckerman and cited in Jim Simons' Wikipedia biography. It never had a single losing year. For context, the same $100 in the S&P 500 over that same period became just $1,910. That is not a typo. And yet, when someone asks you to name the greatest investor of all time, the answer that comes to mind is almost certainly Warren Buffett. Because everyone knows Buffett's track record is legendary. Everyone knows compounding is king. Everyone agrees that 60 years of beating the market is unmatched. But what if the real answer depends on a question almost nobody bothers to ask? There is a reason this comparison is more complicated than it looks, and it starts with a problem most investors have never thought about. Let's set the baseline so you can feel how this lands. From 1965 through 2024, Berkshire Hathaway delivered a compounded annual return of 19.9% per Berkshire's 2025 annual report and CNBC. That nearly doubled the S&P 500's 10.4%. $100 became roughly $6.1 million per Visual Capitalist. No publicly traded company has ever done anything like that over 60 years. Think of it like a snowball rolling downhill for 6 decades without ever melting. Every year the ball gets bigger. Every year it picks up more snow. And because it never stops, never sells, never distributes the gains, the mass becomes almost gravitational. That's compounding at scale. That is Buffett's superpower. His early numbers were even more impressive. The Buffett partnership from 1957 to 1969 returned 31.6% annually versus roughly 9.1% for the Dow per the original partnership letters. But here is the part almost nobody talks about. Because when you compare raw annual returns, Buffett's 19.9% isn't even in the same conversation as Simons' 66%. So the question becomes, what exactly are we measuring when we say greatest? And there is one specific structural detail that changes the entire comparison. Here is where the comparison breaks open. Medallion's 66% gross returns sound untouchable, and on paper they are, but the fund had a structural ceiling. It capped assets at roughly $10 billion and returned profits to its employees every year rather than reinvesting them. As Aptos Capital Advisors noted in their analysis, if you invested $100,000 in Medallion at inception and received annual payouts without reinvesting, you would have collected about $1.2 million in total profits over 31 years. Now picture this: Berkshire Hathaway returning 16.15% annualized over that same period with full reinvestment would have turned that same $100,000 into roughly $9.8 million. That's more than 8 times more wealth from a lower annual return, because the snowball never stopped rolling. This is the deep insight most people miss. The highest return on paper does not always build the most wealth. It's like having the fastest car on the track, but being forced to pit every lap while the slower car just keeps driving. When you notice that distinction, the whole debate shifts. If you're getting value from this kind of breakdown, hit subscribe so the next one shows up in your feed. But here is the part that gets even more uncomfortable. Because there is a specific academic paper that dismantles Buffett's edge in a way most fans have never confronted. In 2018, researchers at AQR, published in the Financial Analyst Journal, released a paper called Buffett's Alpha. Andrea Frazzini, David Kabbalah, and Lasse Heyer-Pedersen took apart Buffett's entire track record. What they found changes how you think about the greatest investor debate. Buffett used roughly 1.7 to 1 leverage on average, financed largely through Berkshire's insurance float. That float, the premiums collected before claims are paid, cost him an estimated 1.72% annually. That's about 3 percentage points below Treasury bill rates. In other words, Buffett had access to a form of nearly free leverage that almost nobody else on Earth could replicate. When the researchers controlled for that leverage and his exposure to quality and low volatility factors, his alpha, the unexplained excess return, became statistically insignificant. His Sharpe ratio came in at 0.76. Impressive, but not historic. Simons, by contrast, reportedly used leverage of 10 to 20 times capital, but his Sharpe ratio exceeded 2.0 across decades per multiple analyses, including Cornell Capital Group's reporting. And then there is a name almost nobody in this debate ever mentions. A woman who was practicing value investing before Benjamin Graham was even born. She predicted the panic of 1907 before J.P. Morgan saw it coming. And her story reframes everything. This is what this channel does. Every week, we take the most important stories in markets, money, and the macroeconomy, and we break them down with the actual data, the actual sources, and the actual nuance that most financial content skips. No clickbait, no hype, no vague opinions dressed up as analysis, just sourced, research-driven breakdowns designed for investors who want to understand what is actually happening and why it matters. If that sounds like the kind of content you've been looking for, subscribe, ring the bell, and the link is in the description. Remember the name I mentioned a moment ago, the one almost nobody includes in this debate. Henrietta Hetty Green inherited roughly $7.5 million in the 1860s and turned it into an estimated $100 to $200 million by 1916, equivalent to $2.7 to $5.4 billion in 2024 dollars, per a 2022 SSRN paper by Mark Higgins and a CFA Institute blog ranking her above both Buffett and Graham. She did this before securities regulation existed, before index funds, before the Federal Reserve. She survived every panic of the Gilded Age and lent money to the city of New York when the banks froze. And Peter Lynch posted 29.2% annual returns at Fidelity's Magellan Fund for 13 years. But a Fidelity study found his average investor actually lost money. People bought after good years and sold after bad ones. The greatest fund of its era was turned into a loss by human behavior. So here is the thought to carry with you. The greatest investor is not a single answer. It is a mirror. It reflects what you value: raw returns, compounded wealth, risk-adjusted skill, or the discipline to stay invested when everyone else runs. The uncomfortable truth is that knowing the answer matters far less than understanding what the question reveals about how you think about your own money. And if this kind of thinking is what you came here for, you are in the right place.